With the raising interest rate that we've seen in the last few months, now we're really kind of reconsidering the way we actually buy a home, especially right now when you're in the 7 to 8% interest rate. So something that you really want to learn about is home loan assumption. So I have with me Mike Roberts from UMA Home Loans, and he's going to be talking to us about how the loan assumption really work and how actually can it be beneficial for buyers and also for sellers. Mike, how are you?
Good. What's up, Sacha?
Yeah. Well, tell me a little bit more about this opportunity that we have now, because it looks like some buyers could buy a home and afford it now, and then they can't really, if they're paying 7 to 8% interest rate, there's no way they can afford it.
Right.
So tell me a little bit about it.
That's so exactly like you were saying is the home affordability is probably one of the reasons that, Rachel, of course, and Rachel's my wife and business partner. I don't recommend it. When we came up with UME, or the concept of UME Assumption Specialist, it was really to get those people that really couldn't afford homes anymore because housing prices going up, interest rates going up, somebody that was qualified for a house and is driving around with their realtors. And then they finally just said, I got to stay in my rental or stay in my current home because I just can't afford it. And we came up with a solution. Like we thought, what's the need in the market? That was it. And then, we really became the experts in assumable loans.
That's awesome. And how is it actually working? Is it all the loans are assumable, or can you tell us a little bit more into details of which loan and how you actually take the buyer from point A to point B,
Sure.
In that.
We go past B, we actually go to like Z.
Okay,
we finish it off for them. So from an assumability perspective, when I talk about like loan assumptions or an assumable loan, the best way I always describe assumptions is first what they're not. And what they're not is all of those subject tos and wraps and contracts or deeds, kind of like the savvier but yet riskier type of creative financing out there. And so a lot of people they'll say, hey, I want to assume your house, but they're actually talking about a contract for deed. I'm not talking about any of that. What we're talking about is your above board, by law, government loan, mandated assumptions. And those are the key difference between those two different types of, what people perceive as assumptions is your contract for deed, et cetera. The seller is still on the hook. Sure. But on the real assumptions, the seller's responsibility is it's a complete release of liability from a loan.
That's great. And those are the VA loans and the FHA loans, correct?
VA, FHA. Technically, USDA is also a government loan out there, but the terms that you assume with those they're not good. You have to assume at the market rate, so they're not really applicable. But yes, VA and FHA are really the ones that we focus on.
For sure. And for me, what I do right now with some of the clients that are really, really wanting to go that route with loan assumption, and that's usually the most economical way right now to buy a home, because you could probably assume a loan at 2.5 to 3 or 4%, and that's amazing for this kind of market right now. So what I usually do is I look for, they have a great website that I go on, and we can look at all the properties that are actually could be assumable. And we make an appointment, we can show the home. And also I want to make sure that they talk to Mike and Rachel first to see if they do qualify to assume one of the loan. And how's that work afterwards? From the time that, let's say we put an offer on a home, what's your work involved in that?
So the way that works is we facilitate the entire transaction.
Okay.
So we process it. We interface with the buyer, the seller, the listing agent, the buyer's agent, and then most importantly, the servicer. And you'll hear me say servicer and servicer over and over. And what a servicer actually is, it's the seller's mortgage company. So whoever's selling the house is their current mortgage company. That's who the servicer is.
Sure.
And the reality is these servicers, they don't want to do assumptions. They just don't want to. It's just that they have to by law. So that's why they're doing them. So we turn a lot of their denials and their no's into yeses, because they act like insurance companies many times. Where they're just like, no, you're denied. And we have to turn that around.
Yeah, and that's the benefit of having a company that specializes in that, because they know who to call at the bank. They know who to talk to and how to talk to them as well.
Exactly. It really comes down to how do you present the loan file or the buyer up front, because if they have a reason to deny it, then it's going to be pretty hectic for someone trying to do it on their own.
Great. And what's the time frame usually from the time that we have a buyer and seller under contract and the time that we can close after and we can give the keys to the buyers?
So usually I would say the average, or more accurately, the median is probably 60 to 90 days with most of the servicers out there. You've got some servicers a little bit faster and some servicers a little bit slower, but the median is probably that 60 to 90 day range.
Great. And is it something that also investors could actually purchase? Is there any restrictions for investors to assume someone's loan?
That's actually a great question. So when I was talking about Rachel and I creating the company based on the need of affordability and people getting into homes, and we've got a ton of great stories about that. But what we've seen is investors, because yes, you can assume a VA loan as an investor. You do not need to be a veteran, and it does not need to be owner occupied. And we have seen investors are just flocking to this.
Sure.
Yeah, I probably think like 70% of these transactions right now happen to be investors, because they're savvy and aggressive when it comes to getting these opportunities.
Well, it's great because you're getting on, year number 5 of the loan, and then it's already a great saving, and then you're getting a lower interest rate as well. So it's really a win-win for everybody. And a lot of the time, the sellers are actually able to get a higher amount for the sale as well, because those buyers they see a value in that particular property that is assumable, and they will go in and come up with full price or above full price at times just to be able to buy the house, because it is a good deal for them.
It is. So that they're based, a lot of times, obviously, excuse me, like investors are basing a lot of their decisions on cash flow and then their capital outgo. And I'm trying to think of a good example that we had is we had a house listed at $875,000 and it got bid up to $925,000.
Wow.
So it's a $50,000, effectively a bonus just for the loan. The loan was at 2.375%.
Wow.
Yeah, it is. It's crazy.
That's great. No, it's always good when you have a win-win situation for a buyer and seller. That's always the best situation.
Yeah.
So, and I think those are great. And especially now, people were expecting this year that the interest rate will come down, but it's not looking like that. Happening. It's looking that it's still going up. And I think loan assumption is going to get more and more popular over the years and over the time. So
they will. I think we're going to be in an assumption market for a while now. I think
that's
so.
Great.
I really do think so.
Well, thank you, Michael, and it's great to see you and great to share your knowledge to my group of followers.
Yeah, absolutely.
And I if you want to know more about it, feel free to reach out to me or to Mike as well. His information is right there. Make sure you like and subscribe if you want to know more about it. See you later.